There was a big focus last week on the restrictions imposed on retail investors who traded at various brokerages, including Robinhood and Webull. But those weren't the only brokerages who restricted trading in various securities. Add to that list Interactive Brokers, Charles Schwab, TD Ameritrade, and others, and you see that the impact was spread a lot wider. Last week we found out that Citadel might have pressured Robinhood to restrict trading, but as it turns out, it was simply a Robinhood decision. So if it wasn't Robinhood, then where did this pressure to restrict trading come from? Well, that leads us to a relatively unknown and underappreciated player in the investment community. That player? The Depository Trust and Clearing Corporation. But wait, who are they, and how could they impose restrictions on Robinhood and other brokers? Among a large variety of services, DTCC does post-trade processing on transactions. What does this mean? Well, every time you make a trade, you don't actually receive the money when you sell or buy the stock. Those transactions take time to clear. DTCC is in the business of moving shares from the selling brokerage to the buying brokerage, and from the buying brokerage to the selling brokerage. This process usually takes 2 business days. And a lot could go wrong in these 2 days. For one, a participant in the trade could lose all their money and not be able to pay up. So, the DTCC expects the broker to post collateral in the way of a small value of the transaction to offset the counterparty risk. But it's not quite that simple. The small percentage that the broker has to cough up is related to the volatility of the asset being traded. The more volatile the stock, the more money the broker has to put down. Stocks like GameStop, BlackBerry, AMC, and other insanely volatile stocks force brokers to cough up more cash while their transactions settled. As it turns out, Robinhood and others simply didn't have the money to put down as collateral, and there was this fear that this crazy Reddit-driven volatility would chrome out of control, driving hedge funds to fail and creating counterparty troubles that could put the entire industry at risk. So at that point, Robinhood and others were simply in no position to allow the feeding frenzy to continue, and they subsequently shut down buy-side trading. At this point, you might be thinking, okay, I'm tracking. Crisis averted. Back to normal next week, right? But that's not all. Immediately after the restrictions went into place, a couple high-profile politicians, to remain unnamed, because I'm not a political guy, weighed in on the financial crisis and showed their ignorance of how the system works. So that opens the door for governments to step in and intervene in something that at this point seems like it really belongs in the hands of the financial markets. Traders, some really inexperienced, who poured into GameStop and other belligerent stocks, were unaware of the requirements the financial system has in place to combat counterparty risks that increases systemic fragility. In the end, as an investor and a trader, I accept the risks involved and the limitations of the system. Can improvements be made to reduce the likelihood of this type of financial intermediation being necessary again? Possibly. But let's not dive in thinking that there is a conspiracy at bay that needs to be addressed. We avoided a significant market meltdown. We avoided system-wide failure. And for the most part, the system worked well for the 100 million transactions and almost $1 trillion that change hands throughout the DTCC each trading day. If you enjoyed this brief series, please go smash that like button below and subscribe for more content similar to this. I'm Matthias Trades, and I'm out.